Right, so this is a post-trade session recap of the trade that I have taken today, resulting in a minus 218 pip loss. So today's Wednesday, the 7th of January, 2026. And what annoys me about this trade position is actually the trade validation was correct. Everything was correct about this, including my levels. What is confusing to me is where stop loss placement should be. And I think for me, even this 4 hour, I expected it to retest its lows. I didn't expect it to break this much. This is a requirement I need to add into the skill set, add into validation, add into requirements. Now, the question I want to ask myself about this trade, which I'll get onto later on, again, I'll touch on in more detail, is, well, how do I know that price action needs to retest its lows before starting to push up? And how can I get in after this has occurred? Or how can I account for this amount of drawdown? So to give context, today's trade position was based off of the 30-minute time frame, the 15-minute time frame, the 5-minute time frame, utilizing that to then aid in the narrative being built on the 4 and the 1 as a support. We didn't get any proper closures on the 1 hour or 4 hour when I took this trade position. It was purely based off of that 15 and the 5. So to break down price action, I have a 4-point checklist. Those have been following me, have seen my videos, would know what my 4-point checklist is. But step 1 is to mark out my current range, which we have done here. And then step 2 is to find the liquidity areas, which we did. If we zoom out onto the higher time frame, you can see that my liquidity areas is here. So price point in this area has order magnets for price action to start pushing up. And this point here is where a strong rejection can presumptuously occur on price. As you can see here, this is what we were looking to mirror, or even this candle structure we were looking to mirror for sells, but then we pivoted quickly towards the buys up when we saw that this is exactly the same replica of what happened with price action here on the lower time frames. So as we dissected price action on the lower time frames, what did we begin to see? Well, we began to see on lower time frames, this area of price being grabbed is exactly the same area of price being grabbed where we got the buys. So as you can see, price action here also swiped the same lows. You're looking at a range too, and that's exactly what price gave you. So I was looking to enter on a retest of this candle, but then as the 15-minute candle opened, you didn't quite get that bottom wick, and then eventually when you got the bottom wick, you already had a top wick, so then I was hesitant on it. But yes, this trade position would have been less risk. I actually got in at a really tough spot. This is an extra 100 pips or almost 100 pips, 87 pips away from my initial entry position, and I paid the price for that. I paid the price willingly for that because I knew I didn't want to miss out the entire opportunity of the market just because I hesitated at this point, right? Actually, all of my levels are exactly the same. The validation, the advantage, the take profit, the stops is all exactly the same. I'm only taking a less optimal point of an entry, and I was fine with that because that was the current rebreak of the 30-minute time frame. That was the current rebreak of the hour or coming up to the hour. So I'm utilizing all of that momentum for price to push us forward. Therefore, that was my next logical point of entry, which was the break at the current highs of the candles. So as price action activated this in, price point also gave us an indication that price isn't yet ready to drive up. So I was expecting price to come back down into drawdown. However, with the current model of trading strategy that I use, I don't have a dynamic management position flexibility of, okay, if the hour or the 30-minute candle closes, top wick on a bullish closing candle, you're not going to automatically close out, because we've previously seen price action shoot up. Right, this was also the 4-hour candle open, and then opened up with a bottom wick first, which to me made sense because you're wick filling first to then get the flip bullish. So what happened in this trade that I didn't account for was the break of the current 4-hour. Now looking at it, it makes sense that you broke the previous 4-hour candle. But what doesn't make sense to me is where should I place my stop loss? Because every single time when we identify ranges, we look at logical price action and I say the levels of which price action should not break should be around this area. And we want to account for this area just in case too. So we'll bring that a little bit down. Boom. There's exactly where I'm going to place my stop loss. Well, if we look at where price action stopped you out, it continued back down from my stop place here, about an extra 30 to 40 pips of drawdown. How do I know to account for that much of pips? How do I know I've got to account for a plus 50 pip range? That doesn't make a lot of sense to me. Maybe if you're accounting for 5 to 10 pips of slippage, that's fine. But for 30 to 50 pips of drawdown, you want to account for that at an extra risk? That's quite a lot of risk over a longer period of time. So how do I know? How can I account for that much of, not slippage, but pips of allowance to make sure I don't get wicked out? How do I know that? I understand that I got to ask myself the question of, well, I've got to understand the 4-hour candle is going to re-break the lows. That was my mistake. I should have allowed for a bigger allowance. But how do I know it has to be that much? This is where I'm asking for a little bit of help from not just myself, but from other traders. If you're watching this and you have experience, you know kind of what this does. It doesn't logically make sense for me to say, look, next logical piece of price action, if I'm looking to mirror ranges, and we're focused on mirroring this area, where's my next viable stop option? Down here. So you're telling me that I'm going to lose on this entire position just because I've got a really bad risk reward. I've got a 1-to-1, you know? So it doesn't necessarily make too much sense to me on why I would be taking this trade in the first place if my risk was this high. But that's what I'm asking myself here coming out of today's trading session. For sure, yes, it was a loss. That's fine. I've got no problem with it being a loss. The problem I have is, how come I didn't see this? It's all about skill set development. I can completely understand this. How do I get into a position knowing I need to act upon a decision here, and I now know that if price action is stalling at this area, you're likely going to come down to re-break the 4-hour lows? And how do I know to account for this tiny little wick price action to come up? Because now, instead of this being a loss, this would have been a break-even trade. Now, it wouldn't be a take profit. That's fine. It's not profitable. It's not a profitable trade, but this is a break-even trade from my entry point. If we look at the traditional entry point that I would have taken if it had everything gone to plan, I would be looking at an entry here, your stop loss at the same place. So if price action rebroke its lows, came up, let's say we didn't get stopped out, you'd be risk-free break-even, still be floating in this trade, and you'd have, what, about 83 pips to spare on this trade position? So it makes sense. Everything in this trade makes sense. You had the liquidity grab, you had price come up, you had the range 2, so you're looking at a range 2 retest entry, which you have here. Price action then pushes up. You're looking at an advantage point at these areas here, mirroring price action, your risk free off of the table. You've got 83 pips in profits before price is now starting to create some form of support, and you're looking to re-challenge the highs. So I'll be surprised to see if price action comes up to 468, 488. This is a proper trade position. It's textbook. So again, the hesitation today with this entry has costed me a little bit, but even if it wasn't for that, it would be the stop loss, and understanding how can I place the stop loss to make sure I don't get stopped out, or at least minimize the probability of me getting stopped out, because this is happening quite a lot. It's happening quite often, and I'm not very happy about it. I always allow for about 5-10 pips of slippage, but 30 to 50 is a little bit excessive to me. So I want to know, is it excessive? What do other traders do? How can I stop myself from always getting wicked out? I think at the end of the day, every single trader has to go through the same thing. I'm going through my phase, and all I have to do is just continue to adapt and learn from my mistakes until we can finally become profitable.